as Pavitra said, is a global slide. Of course, India has its own woes thanks to the mid-cap carnage that's been playing out. And I use that word rarely, but in the last couple of sessions, it's literally becoming, a big mid-cap sell-off. In any case, just to talk about this bear cocktail, that's what I'm kind of calling it. It's a heady mix today. What you have, of course, is the continuing problem of high U.S. yields. The U.S. 10-year is, again, very close to that 5% mark. Let's pull up the U.S. 10-year if we can. 4.95 thereabouts the last time I checked it. So that narrative continues. Problem number one, high U.S. yields. Geopolitics continues as well. There's no sort of let up in that. What got added to the mix yesterday was these numbers from Google's parent Alphabet, and the cloud business there not firing up as much as people had hoped. And that sent that particular stock, Alphabet, down 10%, and it really kind of led to capitulation on the NASDAQ. So that's something new in the bear cocktail, so to speak. That's the bond yield. It's inching higher and higher, 4.97 now. So those are the global cues we're speaking of. The result is that the slide continued across Asia. Asian markets are down between 1 and 2%. Not just that, the NASDAQ futures right now are not inspiring any confidence. The NASDAQ was down 2.5% yesterday. Despite that, the futures are down about 1% again on top of yesterday's slide. I mean, for us here at home, as I said, the bigger problem is the capitulation that's been taking place in mid-caps. There's no let-up on that. And for the Nifty, what's happening is as more and more technical levels are breached and algos take over, all of that technical momentum is only exacerbating the fall on the downside. So there's just added momentum on the way down because of these technicalities that come into the picture. That's what I'm talking about. Let's pull out the weekly performance, and that will put things in context. Just 3 trading sessions done. Tuesday was a holiday, and the numbers are already pretty big. The Nifty itself has lost over 3%, 3.3% to be precise. We're not even done with day 4 and day 5. And the mid-cap index, the fall this week is already over 5%. So it's painful. It's happy tidings when we're going up, but the pain on the way down. And no buyers, Pavitra. Till now, there's a bit of a buyer strike. I think till this settles, people are not jumping in to buy.
Oh, absolutely. And, to top it off, you have the FNO expiry today. So there's volatility expected on that front as well. A very tough session. It's 1:11 on the advanced decline. That is the kind of pressure that we're seeing. The volatility index is also spiked up majorly. I just want to point out some pockets. Of course, this is a broad-based sell-off, but take a look at how some pockets are really looking. All of the shipbuilders which really ran up today are seeing cuts of around 5%. All of the railway stocks which moved up so sharply, I guess, should be all of the pockets where there is that kind of big room to fall, right? I mean, these are the pockets which were seeing huge moves higher just a few weeks ago. A lot of the banks, so take a look at J&K, Punjab and Sindh, Bank of Maharashtra. I can't probably put, all of them on the screen, but it's across the board. The real estate pack has fallen. This week, that index is down almost 7%. These are the kinds of cuts that you're seeing just today. Of course, this is also a pocket where there is that room to fall because even after this fall, this index is up 30% for the year. Some of the mid-cap IT names, like Surabhi was pointing out, the sentiment against IT seems to be a little bit off right now, and a lot of the mid-cap IT stocks are falling very severely. I do want to point out some stocks holding up in the green, on the back of earnings coming through, and that's, really saying something in a market like this. You have Sonata Software, which is up 1.7%. We also spoke with the management this morning, and Sona BLW up around 3%. So that is the shape of the market right now.
I just realized that we haven't spoken too much about Nifty stocks, barring, of course, Axis Bank. Let's pull up that Nifty contribution plate if we can, because there's absolutely no contribution on the upside, really, which is why it looked completely lopsided, but it is what it is. So we just thought we'll point that out as well. In terms of big pressure points, IT continues to be a big down area in the large cap side of the market as well. In addition, there are newer names now on the downside. M&M, for instance, is the biggest Nifty loser of the moment, not Tech Mahindra, which has its own set of problems. Reliance is very quiet before numbers, and the banks, really there's short point, no support. It's the lone Axis Bank there.
Oh, absolutely. And, you have Asian Paints numbers today. That has also slipped to the low point. Reliance, that big weight, which was holding up relatively better, it was at the flat line. That has also seen a move lower. So even on the index, it's a 250-point cut. That's the kind of market that we have on our hands. But let's try to get, some experts in on how things are looking since we have broken below so many important levels. We have Rohit Srivastava, founder and strategist at IndiaCharts.com, as well as Bala of CashTheChaos.com to discuss more where things could really be headed from here. Rohit, Jay, thanks a lot for joining us today, on a day when things are looking this bad, when the mid-cap index is down over 2%, and even on an index level, you have a 1.4% kind of cut. Rohit, I want to come to you first, and I do want your levels in the Nifty Bank, but if we can just start off with what's really going on with the broader markets. We spoke to you just around a week ago. From that level also, there has been around a 5-6% kind of cut. How much more of a downside do you think that we can see in the near term?
So I think we've set ourselves up for what could be a slightly bigger correction than probably was being imagined. We are getting to the first critical support near the weekly bands, which is close to 18,800 in the 18,800, 18,900 range. So we are there now. But can this really be the final low for the market? That I think is becoming a doubt by the day, especially given the global backdrop, because what we are trying to price in now is the possibility that the US trips into a recession, and that can mean further selling in global equities. And then if you start pricing that in, then these supports which we are looking for may not necessarily hold. And that is, I think, the risk that we have to keep on the table now.
Rohit, can you just spell out the levels? I think 18,800, we're precariously close to that. It's just 70 points away from that. What next?
Yeah, so this is one level from where you can at least get a bounce, but a bounce might end up being a dead cat bounce. So give it a few days, you can get a pullback. But once again, I would not be surprised if there's further selling. We break this, then we head towards 18,100. That will end up being a 61% retracement of the entire rally that we've seen from the March bottom. Very similarly on the bank Nifty, it'll be like 42,230, and then below that down to 41,500. So these are the levels we'll keep in mind more for the immediate trend.
Rohit, let me ask you this. You do sound a little more bearish when I hear you, because you've had a fairly positive dispensation towards the market for the last several weeks and months. But today when I hear you, it seems that you feel that this thing has turned. Has it?
Yes, that is the view that I've taken over the last 1 week. I think even after we spoke, I think Thursday, Friday, I started to change my view. I have written about it extensively over the weekend. I do think there is a risk of this having turned for a while, for good maybe, especially because of the risk that the US trips into a recession. That was something which, like we've been long time hearing about the soft landing, hard landing debate. The real thing which has happened is the US yield curve, which was so far inverted, has started to steepen. And that's usually the point at which risk becomes current rather than, some future event. So far it was inverted, means, okay, a recession can come, but it's not an immediate event. It could be 3 months down the line, 6 months down the line. And that's what we've been saying since November, December of last year. Now that it is steepening, the market start pricing that right away, which means you are already seeing US equities fall. That is the first level of pricing it in. And the second is where actual economic data starts supporting it, which may still not happen till December, January. But the thing is, markets are usually ahead of that, and which is where you will have to start being careful from now itself.
Okay, Jay, Bala is also with us, so let's bring him into the conversation. Jay, 18,880 is where we're at on the index right now. How much more of a downside are you penciling in the near term for the Nifty? And, any kinds of supports that you would watch for just in terms of levels?
Hi, Pavitra. Thanks for having me on the show. I suggest most of your viewers would be tracking our interactions of every Tuesday, and if they go back and re-watch all that's on my Twitter handle from the 28th of September or 26th of September, the Tuesday, we've been nailing this almost to the last tick. And if you recall from my 26th of September interaction, I had expected the market to come back for the last time to 19,888 and drop sharply. I had said the drop that we saw earlier was just a preamble to a much larger drop. And the market came up to 19,853. And we are dropping, and the markets are headed towards 18,500. And as I said earlier, this is just a preamble to a much bigger drop. And the fact the market printed 18,887 will have a very significant impact, and elitations like me can take away the impact of that. And I think most of the indices around the world are headed below the 2022 low. And I don't know if you have the charts that I've sent. I had sent 3 charts for you. Do you have it in front of you? I can, we can talk about that.
We don't have the charts, but you could still take us through that.
Okay.
Yeah.
Sure. Okay. If you connect the Bank Nifty from the 2008 highs, an important trend line runs into the high that the Bank Nifty registered at 46,000 unchanged. I pointed this out in May 2023 when the markets were making new high, and I said the Bank Nifty doesn't have much upsides to work with. And, I had presented the chart and we discussed this with Prashant and Surabhi. And the markets what is the important takeaway now is that the markets are coming down from the very long-term resistance, and the Bank Nifty has clocked a double top. The break below 43,000 is a very important breakdown, and it's the fact that it's coming from a long-term resistance and a short-term breakdown. It's going to have a very heavy bearing. The bare minimum right now is 40,000 for the Bank Nifty. That's subject to of the double top breakdown, and the Nifty index is breaking down from a head and shoulders top. And for the objective for that is, that's how I've arrived at 18,500. That's the bare minimum now. And since the banking index is, is having a very major reversal possibly, we'll evaluate what the markets do at around 18,500 for the Nifty. And then, we'll reconfirm if the markets are going below the 2022 low.
Okay, Jay, yes, you've been spot on, and I think you have had that bearish view for a while, and now it's really happening, and we have a bull who's now turned into, I don't know, Rohit, if I can call you a bear now. I mean, whether that's really, or maybe that's a hard word. But yeah, we take your caution on board, gentlemen. The question now is, what should people do? Is there a point of thinking about these downside trades on the Nifty Bank or the Nifty or any stocks, or should you just wait by, let things settle? Rohit, let me take that back to you. And I also want to know whether you actually see a big downside, something similar to what Jay is describing.
I do now. I probably was not in that camp, as you mentioned earlier. For a long time, I've been pretty bullish, and I thought we are into a bull market. The risk has always been there, whether if the US really trips into a recessionary mode. And as long as the markets were not recognizing that, we stayed on the bull case of this market. And now that it has started to recognize that, it becomes important that you price in it at various levels, not just in trades, but also in your investment portfolio, which means that you need to create sufficient cash levels where you become comfortable. That if there is a significant drawdown, you should not be caught on the wrong side, especially people who are, even leverage investments. A lot of people borrow money and buy stocks, as I'm finding out. Those are places to be really careful. As you're seeing, the drawdown in mid and small cap stocks can very, very quickly take all that out. And so that deleveraging has to be sort of immediate. And then after that, you need to create cash for whenever there's blood on the streets, you're able to buy. Now, some people may say this is the blood on the streets. Now, in a normal routine correction, that would be correct. So if this is just a routine correction to an ongoing bull market, then after a rally from 16,800 to 20,200, we've done a 50% retracement. It looks sufficient, right? Worst case can be a 61% retracement at 18,100. But moment we start talking about a US recession, then that typically means that the S&P or the NASDAQ ends up losing 20-30%, at least from the highs. And that then becomes a much bigger call. And like I mentioned earlier, that risk has come onto the table. And so we'll have to sort of price that in whatever de-risking we are doing, so that if something that negative does show up, you are able to actually make, take care of that opportunity when it shows up, because low prices are where you want to really invest again. And if you create cash, then you're able to deploy that. Now, coming to the trades, surely this is reaching a point of near-term oversold. The RSI on the hourly is also at 15. So that creates a case for even an intraday or 1-2 day bounce. The daily RSI is at 28, but in a bear market, sometimes it can stretch towards 15, 20 also. So that cannot be an immediate read. But I think it'll be good to get a 1 to 3 day kind of a pullback, which then gives you a better risk reward to play the next leg down as far as the selling is concerned. So yeah, it does become a sell on rise market, but you'll have to time it. Today might not be the right time. It is also the monthly expiry. So a lot of the selling is because you've reached the month end. There's already been a lot of call writing in the last 2 days, in fact, to a record quantity relative to the puts, which is why the PCR has dropped very sharply.
Sure.
So that makes it short oversold, not a good place to start short selling, but wait for the right time.
wait for the bounce, maybe, perhaps. Got that, gentlemen. Good talking to you today. Thank you for the perspective, and maybe we'll do a round 2 of this, perhaps sometime next week, and we'll have more clarity on whether that bounce is coming and then how to play it and what are the slightly more longer-term trades that individuals can look at. Thank you for joining in today. You have a good rest of the day. We have to take a quick break.